The trade and goods deficit with China is down 10% the first half of 2019, almost $19 billion. Hello, this is Robert Romano, Vice President of Public Policy with Americans for Limited Government, dailytorch.com. Hit that subscribe button. Today, we're going to be talking about China again. The trade deficit in goods with China is down almost 10% and $19 billion the first half of 2019 compared to 2018, and that's according to the latest data from the U.S. Census Bureau. This is great news for the American people and for the U.S. economy, and it shows that President Donald Trump's America First policy on trade with China is having a huge impact. These were with the 10% tariffs that President Trump had slapped on $200 billion of Chinese goods last year, and 25% on $50 billion of goods. That was in place until May, and then he upped it to 25% for the 200. And then in July, he added another 10% for the remaining $300 billion of goods, bringing a total of almost $550 billion of goods that are now being taxed. Well, in June, the first month of the increased tariff, imports from China actually dropped 0.7%, which is really significant. In all of the data going back to 1985, imports with China have never dropped in the month of June. And that's so there's a definite impact taking place there. Overall, imports from China for the year are down already $30 billion. At the current pace, that exports to the U.S. could drop by $66.5 billion or 12% for the year. So that amounts to about a half a percentage point of China's $13.6 trillion gross domestic product. And so that's great news. We had the largest trade deficit on record with China on goods at $415.9 billion in 2018. And now with the new tariffs in place, with them now having an impact, you can see that number, it's on pace for about only $375 billion. So they're making big progress there. I think that this is great news for the Trump administration, is showing the effectiveness of the policies. And it probably could not come at a better time. And you can see other measurements that tell you that it's taken place. So for example, China's economy is growing at the slowest pace in almost 3 decades. And so this is from NPR. China's economy grew at the slowest pace in 27 years as the U.S. trade war takes its toll. The second largest economy in the world only grew at 6.2%. Now, Larry Kudlow, he is also underscoring the importance of and what's happening here, the effectiveness of the policies. On CNBC on August 6th, he said, quote, "The economic burden of these tariffs is almost falling 100% on China." So their economy, which has been deteriorating, you can look at any long chart of Chinese investment, retail sales, and so forth, and you see a steady downdraft. Their GDP, which is probably inflated by several points, is coming in lower and lower. In other words, my point is, with respect to our disagreements and with respect to the president's tough negotiating with tariffs, I think China is getting significantly hurt, much more than we are, as I said before. Kudlow added, "It's not just the powerhouse it was 20 years ago. Everyone knows that. And as I said before, supply chains are moving out, the demand for their goods is moving to other places, and a lot of people are coming back home." So this is a steady headwind for China. But one headwind for us is the devaluation that China is engaged in of the yuan. Since May, when Trump started increasing the tariffs, the devaluation is coming in at almost 5%. So they were at 6.76 yuan per dollar. Now it's up to over 7.06. And so that's about a 5% devaluation there. And that's going to have an impact. We've looked at this in the past with what the effect of exchange rates and is on economic growth, employment, and things like that. This was a paper from Barry Eichengreen and Jeffrey Sachs. And what they found was the effects of depreciation. In all cases of devaluation, currency depreciation increases output and employment in the devaluing country, and then it has the opposite impact upon the country that's not devaluing. So in the Great Depression, as countries were coming off of the gold standard, we saw a huge uptick in unemployment, and then inflation basically died. You had deflation. So the more deflation you had because of the overseas currency devaluation, the more unemployment you had here and the more deflation you had here. And it wasn't until 1933, when we came off of the gold standard, that you saw a inflation resuming, and then the unemployment rate was able to come back down throughout the 30s. And then you went back into deflation in 37, another recession, unemployment goes back up, and then it's not until really World War II that inflation is fully restored and you reach full employment. And so we've seen these trends before. And President Trump, he's mindful of this history, and he's looking at China's devaluation and saying, this is a huge problem. I can only do so much with the tariffs. Federal Reserve, you need to step in. So President Trump, he wrote on August 8th on Twitter, as your president, you'd think I would be thrilled with our very strong dollar. I am not. The Fed's high interest rate level in comparison to other countries is keeping the dollar high, making it difficult for our great manufacturers like Caterpillar, Boeing, John Deere, our car companies, and others to compete on a level playing field. With substantial Fed rate cuts, there is no inflation and no quantitative tightening. Hopefully the dollar will make it possible for our companies to win again against any foreign competition. So surely enough, the Federal Reserve is cutting its key interest rate. They moved it downward a quarter of a percentage point. But what President Trump is saying is that the dollar is too strong vis-a-vis other currencies, and we know what impact that can potentially have. We also saw what impact that's had in the 1990s. China was able to keep its currency artificially low, and that got it a currency manipulator designation by the U.S. Treasury from 1992 through 1994. They kept it down there. And then as China's global manufacturing market share increased, ours decreased. Our labor force participation rate for working age adults, that declined, while China was able to grow its economy. And then they kept the really low peg on the yuan to the dollar all the way up through the financial crisis. And then they started to let it revalue and to float just a little bit. But it obviously has not had the desired impact. And so we want to see a situation where you can have the dollar move with the yuan. If they're going to do overseas devaluations, we just can't ignore that. Matthew Phillips of the New York Times on August 6th, he's pointing to the Economic Stabilization Fund at the U.S. Treasury as an area of where potential shortcomings could be addressed. He writes, the People's Bank of China has the ability to print its currency, to weaken it if exchange rates get too high. On the flip side, Beijing has $3 trillion in reserves it can deploy to keep the currency from getting too weak. But right now, the United States does not operate that way. It has some capacity to intervene in financial markets by using the Economic Stabilization Fund, a vehicle under the control of the Treasury Secretary with about $100 billion of buying power. So then he quotes Joseph Gagnon, a senior fellow at the Peterson Institute for International Economics, and he says, unless Congress gives Treasury authority to beef up the Exchange Stabilization Fund, it doesn't have enough firepower. Well, that's a problem. If we can't intervene on foreign exchange markets to compete with China, and they're able to devalue the yuan at will, then President Trump can only do so much with the tariffs. We've seen this before in the Great Depression era, as a matter of fact. When import prices were dropping, the Hoover administration tried to address it with tariffs, and they used the Smoot-Hawley tariffs. The problem is that as other countries were coming off of the gold standard, it more than offset the tariffs, and it created huge deflation here. And again, it wasn't until we came off of the interwar gold standard and basically met with the British pound and other currencies that were coming off the gold standard that we were able to restore some economic sanity. And so the same thing can be happening here again. I've encouraged the President and Treasury Secretary Mnuchin to look at potentially barring China from buying treasuries if they're going to intervene on foreign exchange markets. Well, let's cut them off of the foreign exchange markets so until they stop devaluing the yuan and let it float. Basically, let's have a trade agreement. Let's address currency. And that until they do that, the United States cannot afford to allow the same thing that happened during the Great Depression to ever happen again. President Trump is mindful of it. He's encouraging the Fed to, basically get its head screwed on straight and figure out what China's doing is having a huge impact not only on trade flows, but on our ability to grow the economy, and other issues. Unemployment could go up if China devalues too much, and so that, who wants to see that happen? And I'll leave you with the close here. But for now, the president can take solace that the tariffs are having their intended effect of reducing the trade deficit with China. That's great news for now. If it hurts bad enough, it might be able to force China to the table. But the Fed has to get the dollar right and not let it get too strong versus foreign currencies, or it could undermine everything the administration is hoping to achieve and take the U.S. economy with it. That's the commentary. This is Robert Romano, Vice President of Public Policy with Americans for Limited Government, dailytorch.com. Hit that subscribe button, ring the bell for notifications, and have a great day.